From the morning reading, spiders, diamonds, IWM, the Qs, XLB, XLF, XLI, XLK, XLV all finished their third week of the rally strong. Earnings heat up for next week. 2 of 9 sectors moved higher and 1 was unchanged on Friday. XLB, XLU, XLP were the strongest sectors while XLY was the weakest sector. Oil futures rose 78 cents to close at 46.28. In terms of breadth, compared to the prior session, it weakened as advancers led 1615 to 1359 on the New York Exchange and led 1405 to 1165 on the NASDAQ. And other reading, the S&P 500 snapshot, another day of fractional loss after 4 record highs. The benchmark S&P 500 was on the verge of setting a full week of record closes, but today's fractional 0.09% decline led to an end of the streak after 4 days. The index hit its 0.24% intraday high about 2 minutes into the session. It then sold off to its 0.34% intraday low during the lunch hour. A slow recovery created a late session mini drama with the index go 5 for 5 on record closes. But alas, it was not to be. Interesting enough, a week with 4 record closes and 1 microscopic loss posted a weekly advance of only 1.49%. The yield on the 10-year note climbed 7 basis points to close at 1.60%. Also in the morning reading, most of this rally occurred overnight sessions. In the week through Thursday, 80% of the S&P's gains occurred outside the regular trading hours. That's an unusually large percentage when stocks have rallied hard to new highs. When we've seen this kind of behavior in the past, stocks tended to struggle over the next couple of weeks. The push to new highs has led to extremes in sentiment models. Most of the medium-term models we computer track are showing a high level of optimism. The CNN Fear and Greed proxy model is nearing 90% and is in the top 5% of all readings since 1998. When the model has hit this kind of extreme, how the S&P 500 fared over the next 2 weeks was a good tell on how it would perform over the ensuing 1 to 3 months. Note and bond yields have reversed sharply. The yield on the 10-year Treasury note showed its largest 1-week percentage gain in more than a year, coming off a multi-year low. Similar reversals since 1962 have led to a continued push higher in yields most of the time. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:37 a.m. Mountain Time, and I'm recording this in preparation for the market day of July the 18th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and bounce into the morning report. And at the time of this cut, all 4 broad market U.S. indices were positive, with the S&P up about 0.25% and the NASDAQ also up about 0.25%. The other 2, the Russell and the Dow, just basically up above scratch. Crude oil was up about 0.5%. Euros down just below scratch. Bonds are up about 0.25%, and gold down just below scratch. In overseas action, you have Japan is closed, it would seem, so this is a price from 7.15, so be aware of that. China, though, and the others are open. China up about 0.2%, as is Hong Kong. Germany's up just above scratch. United Kingdom up about 0.33%. In terms of macroeconomic reports for today in the United States, of note, that is a clear calendar, just 1 yellow flag report. And looking forward to tomorrow, there are building permits and housing starts on the U.S. calendar of note. And looking at current volatility conditions, obviously volatility has been decreasing. Short-term VIX down to a 10.26. I know the regular VIX dropped below 12.5 at one point on Friday's session. So very, very low volatility currently. And look at the IV percentiles. All four of these are now in single digits, and the Dow sitting at a perfect 0. So volatility doesn't get much lower than this, and that should serve as something of a warning to be on the lookout for reversal signals. The S&P is at a 6, the Russell at a 7, the NASDAQ at a 4. And of course, Friday was a FOMC options expiration in the monthly. So tend to have days that kind of go sideways, and indeed there were no standard deviation moves on Friday's session on a close-to-close basis. In terms of the charts, we'll go ahead and take a look at our S&P futures, and you see we seem to have kind of run into a situation where we're running out of gas. Now Friday, of course, was a subtle, on the futures chart, subtle retracement and basically a bearish harami. But so far today, that's not confirming, and action is slightly positive with an open that's up above the Friday close. We're still well up above the area of resistance, and we're waiting to see if we get some sort of bull flag pattern, perhaps a retracement, and we'll also be watching to see how far retracement we get before that next bullish leg. That retracement could come down and retest this area of support, which was the prior resistance. So we'll want to watch that action and make sure that that doesn't fail. Anything below about 2100 would call into question the entire breakout. Right now, we don't see any evidence of that, though as you got from the morning reading, we've gone up, kind of unusual in that, we've had all these record closes and yet really didn't advance all that much, only 1.49% for the week on a week with 4 record closes. The other thing, of course, you heard from the morning reading is sentiment, and we'll look more into that specifically as we get into the daily report. But sentiment is near record extremes, so it would seem that we should be setting up for something of a retracement. Now that we're past the monthly expiration, it'll be interesting to see what the next couple days bring. The other thing to keep in mind is that this has been on the backs of the S&P and the Dow, and certainly while the other indices have surged forward, these record highs are here in the Dow and the S&P. And you see so far with last night's overnight activity, we actually ticked up to a new 52-week high on the Dow futures. But then when you go to the NASDAQ, obviously, we've had a very important bullish breakout of diagonal resistance, and even you could perhaps mark some horizontal resistance, but we've still got some room to go before we get to the all-time highs, something less than a couple hundred points. The same thing on the Russell. The Russell also is broken out of an important diagonal resistance and also broken out some, more intermediate term horizontal resistance, but also still has, some 50 points or so to go before it gets to its all-time highs. So some real divergence perhaps in relative strength and where the strength is coming from in terms of those growth-oriented components of the marketplace, being the leaders in this bullish breakout. The other thing we'll take a look at is crude oil. That divergence is broken down of late. The correlation is broken down of late. We normally, in recent weeks, have seen a very high correlation between the crude oil bullish move and equities bullish move, but that seems to have separated, and we now seem to be forming something of a potential wedge pattern, but it's also in the cloud. So very, very neutral posture right now on crude oil, and that probably isn't going to help the equity market. In terms of safe haven status, you see gold Interesting here in that safe haven status doesn't seem to be picking up at all with the attempted coup in Turkey and the weekend action, which started right after the markets in the United States closed. So that doesn't seem to be instilling any fear in the broad markets at this point, as measured in gold. In terms of bonds, also not much of a reaction here. Bonds are up a little bit, but nothing extraordinary by any measure, and it seems to still be in something of a retracement pattern. Bigger picture, the risk on move, where perhaps we're starting to see more evidence of money coming out of gold and money coming out of long bonds to move into equities, might be starting to find some substance to it. And let's take a look at volatility. As you can see, volatility has continued to go through its crush, and it's basically gone straight down ever since the post-Brexit period, with activity, in the intraday dropping down to a 13.4 area on the VIX futures. Regular VIX, you could see, is picking down here off the floor and has toyed with this 12.11, 12.27, in the Thursday and Friday session. So we're starting to play into the 12 handle with these volatility lows. So the question is when do we start to see a increase in volatility and perhaps a retracement in the broad market? Record lows being seen on some of these sentiments. Let's go ahead and go to the daily report, and we'll get into that. In terms of, first of all, our top of this report, we go into our market timing signals and general market posture. Our intermediate term phase opinion, currently phase 2, trend reversal, a bullish phase, a break of diagonal and of horizontal resistance. And of course, this is focused on the S&P 500, but this is also true of the Dow, and is with respect to diagonal resistance, has been true of the NASDAQ and Russell as well. In terms of the 3 market timing signals, our first signal comes from IBD in a confirmed uptrend, so that's strongly bullish. GMI index, a perfect 6 out of 6 on the regular index, and GMI2, the more sensitive one's also an 8 out of 8. So that market timing signal is also strongly bullish, with a bullish signal in place since 7-1. In terms of the third one, from Stock Charts Decision Point Scoreboard, we are short-term, intermediate-term, universally green. Long-term is the lone fly in the ointment. We continue to wait to see for this to resolve and give us that perfect stack of all green, all indices, all time frames, and then also to have all 3 of our market timing signals universally green. So it's just about there, and you have to give the bulls their due. This is about as strong a bullish signal as you can get from those market timing signals. Position sizing opinions, as you would expect from the above, are both at 100% in both those mechanical models. Intermediate term market posture, severely strong bull signal supported by a bullish sentiment line, and you note that all 4 are up over 90. So these are about as high as they can get. Now, even once they may start to turn and slide, as long as they stay above 80, they'll still be considered severely strong, and you can theoretically stay in these very strong areas as an oscillator for extended periods of time. In terms of the strength of the trend, it is certainly very strong, well up over 80 on this indicator. So our strength of trend indicator certainly isn't showing anything to be concerned about. Hedge warning status, we're level 0 plus, which is normal with some cautionary aspects. We'd like to see for this to go to full out level 0, which hasn't happened in months. Would need to see this last set of signals turn green, and to be able to hopefully support a bullish trending move, and not just a rip for a couple, 3 weeks, and then just a retracement all the way back at the bottom of a range. We'd like to see some actual higher highs and higher lows and a real bull trend form, something that we haven't seen in about a year and a half, all the way back to November of 2015. In terms of strategy opinions, our special opinions of option income strategies, VIX is in the acceptable window to initiate new positions for novice traders. Just keep in mind that we're actually just about to go to the opposite side. Volatility, if it drops below a 12, that would be a warning to expect an increase in volatility. And for novice traders, at least, that could be a difficult place to do option income strategies because premiums are low and the odds of an uptick in volatility start to increase. We're not there yet, but certainly big picture, this should be a situation where normal option income strategies should be underway. Covered call strategies and put selling starting to become more bullish as we build confidence in this bullish breakout, and currently not just initiating new positions, a few at a time, but also using a 1-to-2 ratio of in the money, out of the money strikes, and a 1-to-2 ratio of low beta and higher beta positions. Those more aggressive positions you might consider legging in through out of the money put selling, and then of course keep that position size and a scale you're willing to own if you use that tactic. Put selling outright is a great thing to do on any kind of retracement in a strongly bullish market as we seem to be in at this point. So all three of these strategies are pretty much good to go, and just kind of consider the individual charts situation as to just how aggressive you might be with that. In terms of specific warnings, really only 2 mild warnings in the volatility area. This volatility ratio warning has reset. It's back into the extreme area, and so we're now awaiting a firing of that to show increase in volatility. That has not yet happened. It's just in the position ready to fire. Skew also just barely over the caution area of 125, so about a 9% probability of a 2 standard deviation move in the next 30 days. So in balance, this is all very, very bullish. Just a couple very mild areas of warning. And the trend base, they're all bullish, including up over the bullish window of 300 for the New York Stock Exchange, new highs, new lows on the 1 month, 373 versus only 18 on the new lows. In terms of the key intermarket, all 5 risk on, so no issues there. As one of the morning authors mentioned, there is some extreme starting to be shown in the sentiment indices, especially on the intermediate term. You see a 7 here out of 10. Bonds, also gold, have gone back into some more extreme sentiment. In terms of ETFs, specific high sentiment on ETFs, you got mining, silver, and retail are all 3 up in that upper quartile of extreme sentiment. So be watching for potential reversal patterns. One of the morning authors mentioned this indicator specifically, the CNN Money Fear and Greed Market Sentiment Index, and indeed up here at an 89. This is about as high as you ever see this indicator get, so you should be very, very careful that watching for those potential reversal signals. Frankly, have your watch list ready. If this is truly a bull market, this retracement should serve as an accumulation point, an opportunity to sell some puts, an opportunity to re-enter some positions. It should be a gathering point and not something as a point of failure. Not until you get below on the S&P futures chart, about 2100, would you start to call into question the breakout. In terms of sectors percent change, you see all are a sea of green with the exception of utilities, and this frankly is probably would be given as a bullish signal for the broad market, in that when you start to see utilities and some of these other defensive sectors start to give up a little bit of their strength, it's at the benefit oftentimes of the more risk-on kinds of areas. Now, utilities were actually positive, as for telecom and consumer staples essentially scratched, whereas some of the higher risk areas were actually mildly bearish on Friday's action. But let's not make too much of this. This was FOMC day, and it was a day that was essentially sideways, and you don't really see a lot of separation between most of these sectors, positive to negative. Okay, in terms of the relative rotation graph, this has started to shake out and start to show some positive consistency on several of the industry groups. FDN, which is the Internet Index Fund. You have IYR, the Real Estate REIT, IYZ, Telecom. You see utilities have been starting to gain some strength and come back and head back towards this upper right corner as well. So for the most part, you have what I would still call more defensive-oriented areas of the marketplace, or the best performers, but you also have some mix of others that perhaps aren't quite as defensive. Home construction, semiconductor, certainly this internet, this FDN has been one of the most consistent to pop its head up and show strong bullish activity anytime the broad market shows bullish activity. So when broad market goes negative, of course, it does fall back. But as soon as you start to see green shoots, you tend to see this FDN. So I just mentioned that if you don't have that on your watch list, you might want to take a closer look at that chart. It's been one of the most consistent producers for quite a number of months. In terms of, I think that's probably enough. We've gone up over 20 minutes, just a little bit long for a Monday especially. Let's go ahead and sequence this to our disclaimers. Disclaimers, as always, if you hit the pause button, you can get more time to review the disclaimers. Also note down here at the bottom the hyperlink that will take you to the full set of disclosures. We'll see you back here for the next market preview with the next trading session. In the meantime, manage that risk, and everything else should fall into place very nicely. Good trading. We'll see you tomorrow.